Welcome to the Barometer Readings Monthly Conference Call. My name is Chris and I will be your operator for today's call. At this time, all participants are in a listen-only mode. Later, we will conduct a question-and-answer session. Please note that this conference is being recorded. I would now like to turn the call over to Mr. Nick Hamilton. Mr. Hamilton, you may begin.
Hi, everyone. Thanks for your time, and welcome to our regular monthly Barometer Readings conference call. It's Nick Hamilton, National Vice President of Sales. So on the last few calls, we spent time highlighting the sector leadership rotation we've witnessed since earlier this year as longer-term bond yields have moved higher. In this backdrop, interest rate-sensitive securities all moved lower, and Barometer conducted considerable shifts within our portfolios to protect your investors. With a stabilization in yields, though, more recently, or even yields backing off as they have, income securities have had a bit more of a tailwind effect and continue to act very well into Q4. So far, in fact, October results have been very strong, reaffirming this outlook. On a year-to-date basis, our strategies are performing very well right across the board, as we'll review. On the call today, as always, David Burrows, President and Chief Investment Strategist, will review our market leadership models, breadth and trend observation, as well as positioning. Also joining us is Sal Malik, Portfolio Manager, who will discuss specific themes we are seeing go through revaluation, such as energy, and individual positions that are having a material impact within our portfolios. So with that, I will turn it over to Dave.
Hey, folks. Thanks for joining us today. It's kind of hard to imagine we're sitting here towards the end of October, the end of the three seasonally weakest months of the year, and we're sitting with indices basically sitting on the highs. Equity markets have been very strong, incredibly resilient going through this seasonal period, and I think that there's a lot of reasons to be optimistic going forward. Just to quickly review, over the last number of months, we talked about the fact that ultimately, while we were seeing bond yields rally and bond prices fall, that we did not believe this was a precursor to a more significant longer-term move higher. And so while we were seeing some headwinds for income securities in the spring and early summer, we thought ultimately that was likely to moderate given the fact that the factors just have not been in place for a move beyond sort of the 3% level on a long bond. We continue to believe that that's the case, and I think that that is beginning to be borne out. Just as a quick review, the four things we thought we'd need to see happen to see a more sustained, longer-term move higher in rates are, first of all, a move higher in inflation, which clearly, we're not seeing. Interestingly, I was looking at a chart this week that breaks out the sources that make up CPI in the U.S., and of all of the various sources, the biggest one is housing. And that is the only one where inflation is running above 2% at 2.2%. And frankly, that is the one piece of CPI that the Fed would like to see higher. So CPI and housing is above the 2% range. Every other piece of the composite is sitting below 1.5%. And so there really is no risk at this point from inflation. On the jobs front, we talked about moderating jobs numbers. And if you look at the moving average over the last 5 months, moving average is moving straight sideways. And in fact, today the employment data came in a little bit less. So the job growth is not accelerating. It's a good thing. Things are getting better, but just marginally better and not accelerating. When we look at credit risk, CDS pricing around the globe is sitting at 5-year lows. The premium you can get to buy an Italian bond or a Spanish bond versus a German bond is at the lowest level since the European crisis. So credit risk doesn't appear to be a problem. And GDP growth, is moving modestly higher but is not accelerating. And certainly the move up in mortgage rates earlier in the summer did have a moderating impact on new home sales and refinancing. So we've seen the 10-year come from 3% back down to 2.5%. Over the last 6 weeks, we have seen far less disparity in price performance for securities that are more interest rate sensitive than more economically sensitive, and certainly the backup or the headwind that we've been facing in the income strategy seems to have moderated. Importantly, the dividend growth-oriented securities that we're focused in the income portfolios, both the Income Advantage Fund and the High Income Pool, are continuing to act well. If you look at the S&P 500 payout ratio, still is only 33%. It is moving higher, but is way below the historical average at 50%, and certainly way below the peak payout periods in the 60s and in the 30s at over 70%. So we think that can go on. The dividend growth can go on for a long time. So in the absence of a headwind from interest rates, we do think that there are a lot of people who have moved money from the bond market and need to reinvest. We think the most likely place is to be in these dividend growth-oriented securities. Investors are still fairly cautious, and we certainly are seeing good price performance out of a number of sectors that are benefiting from dividend growth. When we look at equities as a whole, those breadth models that we follow, where we track the percentage of stocks on a global basis and in various geographic regions and in various industry groups that are performing well at any given time, the breadth models have been solidly positive through this fall period. 55% of stocks globally are performing well. That is solidly at midfield territory. It's nowhere close to 70 or 80%, where when a very high percentage of stocks are doing well, you're getting to a point where things are overcooked, and it's certainly not down at the bottom end of the range where very little is working. We've got a broad-based rally going on. The percentage of stocks doing well is improving slowly across the board. The developed markets have the broadest rallies going on. So, of course, the U.S. and Japan and now increasingly Europe have the highest percentage of stocks doing well. Emerging markets have the lowest percentage of stocks doing well, but even we are seeing some improvement in EM. So broadly across the globe, the risk models are showing improvement. Even the short-term indicators as we move through the fall continue to be positive. So in general, we are much more bullish on stocks. What's supporting that is the fact that the equity risk premium continues to be very good. In other words, the earnings yield on the average company, the S&P 500 right now is about 6.7%. The bond yield at 2.5% means that there's about a little over 4% premium we're getting paid to take equity risk. So that risk premium is very substantial. If you look back over the last 30 years, it's about as good as it gets. So we're getting paid very well to take equity risk. And when we look at equity ownership, both pension funds and individual investors under-own equities currently, but are working their way back into equities. So we think that there is a tailwind. Now, a couple things to take away from the makeup of the rally so far this year. It has largely been driven by PE expansion, or investors revaluing equities. As we have talked about for 12 or 13 years, we're in the business of finding opportunities where you will find PE expansion, things which were changing for the better, where we could get paid a higher multiple over time. I think it's very interesting that this is really the first year in a few years where we're getting PE expansion. The 1990s, the last secular bull market, was marked by PE expansion. Almost every year in the 90s saw multiple expansion. So through the 80s and 90s, you got earnings growth, but you definitely got earnings multiple expansion. The period between 2000 and 2010, very little PE expansion. So when we look at the chart, for instance, of the S&P 500, the fact that we are now 7 months trading above the range we were in between 2000 and 2013, the fact that we have such a strong equity risk premium, the fact that we have such a broad-based upward move in breadth, and the fact that we are seeing PE expansion this year, all points to the fact that we may, in fact, be in a new secular bull market for equities. As a firm, we have been moving our portfolios more and more to the equity camp. If you look at the makeup of the portfolios, you know through the course of this year, the high-income portfolio moved largely from a portfolio of interest rate proxies, REITs, pipelines, utilities, and telecoms, to things that are a little more economically sensitive, a little lower payouts, but higher dividend growth. The high-income portfolio today is about 90% equities. Now, they're dividend payers. They're not out on the far end of the risk curve, but they are slightly more economically sensitive. The internal cash flow yield in the portfolio is a little lower, but the total return looks more attractive. So as it stands today, the income portfolio has by far the biggest weight in financials, but that breaks out into three camps. Insurance companies that are benefiting from better equity returns in their equity portfolios, commercial banks, which are seeing better business conditions and improved opportunity for loans, and the asset managers certainly that are benefiting from an improvement in equity markets. So we do think that we're going to see pretty strong dividend growth, both in the U.S. positions that we own and in some of the Canadian financials. Beyond that, we do have a bigger weight than we have had in a while in energy. We're getting a great tailwind from that part of the portfolio. And to be clear, this is not big cap, traditional, conventional oil producers or integrated. This is mid-cap oil and gas producers that are finding oil reserves at low cost. I'm going to get Sal to talk a little bit about some of the positions that we've got both in the equity portfolios and the income portfolios. So financials, energy, and then that's followed up in behind with some high-yield bonds, which are behaving extremely well since midsummer. They started putting in higher lows in July while the sovereign bonds, treasuries were selling off. REITs are now showing some improvement. And then you go from there into consumer discretionary like media, auto, and some industrial. So the portfolio is more economically sensitive. Since I guess mid-September, we've seen a nice lift in the positions. The Income Advantage Fund, which we launched in January, now is sitting up about 10% on the year. The income pool is sitting now up about 5%. And certainly getting a little better day by day, 5.4%, and we're very happy with that. Only so far we can go with an income portfolio, so certainly in the equity portfolios we have been a little bit more aggressive in our move to the U.S., a little more aggressive in our move towards more economically sensitive groups. We talked a year ago about the fact that we were really battling very high correlations in the market where everything was acting the same. In October, November of last year, correlations in markets geographically and sector to sector and stock to stock started coming down, and we got into more of a stock-picking market. I'm really pleased that the equity strategies are performing well. The Barometer equity portfolio is just a snip ahead of the S&P 500, which is about the best index of the year. S&P is up about 22. TSX is up about 5%. Europe is up low teens. The Barometer equity is up about 23%. Long shorts up about 22. And those portfolios weightings are more weighted to, well, certainly energy is a big weight, and energy service, but technology, consumer discretionary, including auto and media, communications equipment, and leisure are big weights in the portfolios. So we are seeing some pretty strong numbers come up in the earnings reporting period in our portfolio. We're pleased to see that. In the global portfolios, while U.S. is a very large weight, we have been bringing up our exposure in Europe. Europe certainly further behind in recovery, but we are seeing at the margin net improvement across the board, and there are certainly some winners that have taken market share as Europe has gone through its more difficult period. So we're going to bring Cameron on the global side on our call probably in the next call, but today I wanted to bring Sal Malik in. Sal spent, as you know, a lot of time working on the income portfolio over the last few years. He spent a lot of time in the energy patch and recently had a number of days of meetings with some of the companies that we're invested in. And I asked him to come on to talk about some of the developments in the Permian Basin because we're having some real success there in some very interesting positions. I'm going to pass it over to Sal.
Hey, thanks, Dave. So, guys, beginning of 2012, for the first time in a very long time, we did see IPOs in the energy patch in U.S. From companies that were not gas-based but were oil-based, and companies like Sanchez, Matador IPO'd with exposure to the Eagle Ford, and then Diamondback IPO'd with exposure to the Permian Basin. So when we had meetings with them, it was interesting to find that the reason why they were IPOing was because they had been doing vertical drilling on those plays over the years, and they have realized that if they go to horizontal drilling with multiple fracs, they could enhance the recovery rates and over time reduce the cost per well. Given at that point we were not positive on the energy space and our models were not constructive, we kept on building knowledge on the space, and in June this year, when we did turn positive in the energy space, we started building positions. So it's interesting to see that in the Permian Basin, Pioneer is the first company that actually has been able to break the code in terms of the resource, and they have been able to produce from 3 different zones in the Permian Basin, and with the potential to go to 5 different zones. And I think they're in a position to increase their resource by almost 100% over the next 12 months. And we're looking at paybacks on these wells from anywhere from 6 to 9 months. So these are very profitable wells at current oil prices. And the interesting thing is technology is really helping reduce the cost, because in U.S., in the Permian and the Eagle Ford Basin, everyone has gone to pad drilling. So they drill 4 to 8 wells per section, and then they bring in the frac after they have drilled the holes. And so costs have been coming down anywhere from 5 to 10% over the past 2 to 3 years, and we think there is further room for bringing the cost down. And then the well spacing used to be around 300 acres per well. It has come down to 150 acres, and actually EOG is using 45 acres in the Eagle Ford. So well spacing is coming down, recovery rates are going up, and costs are coming down. And this has resulted in PE multiple expansion in most of the names in the Eagle Ford and the Permian Basin. We saw this opportunity, and not only we bought the E&Ps, we also bought a company like Core Lab that actually does the reservoir engineering, and that company has worked out pretty well too. And we also bought Halliburton that actually provides drilling and fracking services. So given that we never like the market, given that when we find opportunities where we see multiple expansion, we increase exposure. We were able to own the drillers, own the technical service companies, and then own the companies that had big resource play where they can increase the reserves. In many cases, most of the companies like Sanchez has increased production by 100% this year. Pioneer has increased production by 25%. Matador is a company we own that has increased production by 30%. But the fact is that we believe that these companies can increase production by 20 to 30% for the next 5 years. And whereas in Canada we have to worry about infrastructure and pricing, in case of U.S., in the Permian Basin, that is the biggest oil basin in North America, there is enough infrastructure. So the price discount is much lower, and you're getting WTI prices. Given if you're in Canada, you're getting a $5 to $7 discount. So that's why we have more exposure to U.S. energy names. When it comes to Canada on the income strategy, we own companies like Whitecap, Surge, and Torque, which have come up with a sustainable business model where the capex and cash flow adjusted payout ratio is lower than 100%, and they're providing us a nice 5 to 7% dividend yield, plus a 3 to 5% production growth, and all these companies have low decline rates. So we believe we are very well positioned in this space, and we see further enhancement in recovery and reduction in costs. So these companies can go through further PE multiple expansion. With this, I'll pass it back to Dave.
Great. So Sal, thanks for that. When we talk about Permian, part of the reason that we think it's so interesting is that it is just such a large resource. To put it in context, if you talk to Pioneer, they believe there's 8 Bakken zones stacked one on top of the other. And so the potential there is for reserves in excess of what's held in the Ghawar Basin in Saudi, which is the largest oil basin in the world. So if you can recover new reserves at low prices in a very large reserve, ultimately the market can pay a high multiple for that. And in the case of Pioneer, they're putting $1 in the ground and finding $3 worth of oil with very short paybacks, and we think that that's attractive. So I just want to go back and wrap up and make sure I've made this point. We've been running straight equity portfolios for well over 20 years now, and had wonderful returns through the 90s, had excellent returns in the period between 2003 and 2008. Both of those periods were marked by considerable reductions in correlations. So you went from everything behaving the same to correlations going as low as 30%. So far this year, we've seen the beginning of another significant move lower in correlations. Now, correlations are still sitting around 60%. So we think correlations can continue to come down substantially. When we look at the bullish percents at 55% globally, we're solidly at midfield. The valuations for equities, we think, are historically very cheap. And we think that there are no major macro issues sitting on the sidelines that are about to jump ahead. Now, there's certainly going to be issues. There'll certainly be times for correction. But in general, the way that things are set up is that it looks as though equities could sustain a pretty significant tailwind for a while. I think that the portfolios are positioned in some very clear themes in the market, and we are certainly seeing PE expansion from levels that are not expensive. So fourth quarter sets up pretty well. We're certainly happy to take any questions that you may have, but at this point, given where we are at the time of the year and given the way markets are acting, we're optimistic for the fourth quarter.
Great. With that, maybe I'll just conduct some closing comments, and then we'll open it up for Q&A for either Sal or Dave. So probably want to place emphasis again on the market environment being quite good and favorable to our process right now. I mean, market leadership has clearly shifted over the course of the year, and our process has guided us accordingly. I mean, if you examined our portfolio makeup a year ago, things look materially different. So today the market is clearly favoring securities which respond more to economic sensitivity versus interest rate sensitivity, and we're happy to say that we really did protect investors well this year from another cyclical backup in rates. We continue to emphasize that our attributes as a small and nimble manager, as this helps facilitate these tactical moves over time. And despite all the market headwinds and headlines, this year actually has provided a suitable landscape to demonstrate what it is we do here at Barometer. As a manager who also seeks to identify market themes, I think Sal spelled out the opportunity we see with the U.S. Permian Basin and how we can participate and really push on some of these sustainable themes and generate good results for investors. So overall, we're quite constructive on the environment for equities within developed markets, and we've put most of our recent cash to work. Results to start Q4 have been very strong, as we've noted. In terms of client resources, we'll be sending out our Q3 commentary out tomorrow, which will be a good piece describing some of what we discussed today to use with your clients. And obviously, as a follow-up, Sarah and I can provide more context on any of this, and we're happy to discuss with you offline. We're actively building our Q4 and Q1 calendar, and we'd be happy to spend more time with you on the work we're doing. So with that, we're happy to open it up for questions. Operator?